Hi, everyone. I hope you're staying safe wherever you are in the world. I'm honored today to host Dr. Carole Nakhle. She's a world-known expert in macro oil and geopolitics, and it takes us a great honor to invite her again. And why do I say again? Because we were blessed a few years back to have Dr. Carole with the CFA community globally, having when COVID hit everyone in the world, we had almost the same webinar on oil. And Dr. Carole had 1,500 people willing to dial in that day. Unfortunately, we only were able to host 1,000. So let me just set the scene quickly. Today we have 800 people registered for this webinar. Let me just thank all the countries who contributed to this, all the CFA society based in the countries that contributed to the success of this webinar: UAE, Egypt, Saudi Arabia, Pakistan, Qatar, Poland, Bahrain, Kuwait, South Africa, Portugal, Jordan, India, Lebanon, Turkey, Zambia, Oman, Switzerland, societies of East Africa, Mauritius, Luxembourg, Greece, and much more. Thank you so much for being with us. And please feel free to use the chat box to send your questions. Also remember, as a charter holder, you're supposed to keep up with your learning, and you receive PLs every year and credits. So professional learning. So for this webinar, you'll also receive professional learning because you dialed in. And you've, of course, asked smart questions. Thank you so much. Dr. Carole, first of all, thank you so much for being with us. I know you're so busy on BBC, Bloomberg, and the whole media is trying to grab from your time. So thank you so much for giving us an hour of your time. I would like to give you the mic now to go through a presentation that you prepared for us. So thank you for that. And we start with the Q&A just after the presentation. Thank you so much.
Thank you very much, William. It's really great to join you again. I have to say I was smiling because you seem to contact me when there is a major development in oil and gas markets. And I do remember when we had COVID, it was really, we were all sailing in the fog, almost similar to what we are facing today, a bit of different nature. But it's really a great pleasure to be with you today. And I told William just before we went live, I said, whatever I say now may be proven wrong in a few hours' time. But sometimes it's good to take a step back and try to make sense of what's going on in the bigger picture rather than being in the middle of the storm and unable to see the way forward. So this is really what I hope to do today in the next few minutes. I want to do a reality check on oil and gas markets. I may be getting it all wrong, but I'm an economist. I like to look at what was the situation before this conflict started and distinguish between the noise that attracts media headlines, political statements that are, of course, driving the market, and the fundamentals on the ground. Where do we see the structural shifts versus the temporary noises? And that makes us actually better equipped to analyze what can happen next and what are the implications of what is going on today on global energy markets and the global economy. So this is a kind of mindset I came prepared for this presentation. So first, I'd like to go briefly over the last few years and primarily last year, for example, what was the landscape, because that will help us understand a lot of what's going on today. Then look at, okay, so we're in the middle of a storm. How is the system coping, or what parts of the system have been affected? Then do a little bit of reality check, dig deeper into these kind of changes that we are witnessing, and then look at what could happen next. Together, we're going to gaze into the crystal ball I have prepared for today. But very briefly, let's look at the pre-conflict landscape. First of all, it's not that we were living in a very peaceful situation. Everywhere you looked, and here I have a very modest depiction of various tensions around the world. I like to describe this as tensions without borders. Everywhere you looked, you saw countries either fighting each other or under sanctions or instability within the country or civil war within a country or another. And these tend to happen primarily in oil and gas rich countries, producers and exporters alike. So this was the kind of scene. It's not like we started from a very clean state of world peace and international relations. And plus, on top of that, we saw an unprecedented global election cycle in 2024, the biggest election in human history. And with that, we saw policy volatility. So lots of sudden changes, government changing around the world. And that's why it creates some kind of an additional layer of uncertainty because many governments came with 180 degrees difference in terms of policy to their predecessors. We also saw greater political and economic fragmentation around the world. So after we lived many years in a harmonized, globalized world where everybody believed that globalization is great, we start to see a greater protectionism and greater level of what we call economic nationalism, for example, with tariffs, export controls, taxes on whatever you want to call them, on imports, even you want to call them or you give them the name of carbon taxes, CBAM in Europe, for example. Even before that, Brexit in the UK. All these were like major trends already shaping our world. And also, we saw in the energy world energy transition fatigue. So, for a while, we saw, for example, before 2025, people were saying, oh, we don't need any more oil and gas, let's move on. The mighty International Energy Agency became very famous in 2021 when they said if you wanted to reach net zero by 2050, we should stop investing in oil and gas and any new oil and gas fields beyond 2021. Then fast forward 2025, just after all those elections, we saw the kind of pendulum swinging to the other extreme, saying that no, we need more oil and gas, forget about the energy transition, it's a myth, and we should be more realistic with in terms of our agenda when it comes to energy security versus climate security. At the same time, in oil markets in particular, we saw disruptions. We saw Russia's invasion of Ukraine. We saw Israel-Hamas war. We saw Iran and Israel trading direct attacks. We saw the US also attacking Iran, although they were targeted. And what you see here is the oil price, Brent spot oil price. And people were saying, oh my goodness, the market is really ignoring these disruptions. I don't like the word ignoring because markets do not ignore, but there was something stronger in the market happening that made us live in this kind of relatively longish period of lower oil prices, let's say in the region of the 60s to 70 corridor. And one of the reasons why we had this kind of ignoring geopolitical developments is simply because we had too much oil chasing too little demand. So, in other words, there was a surplus in the market. And what you see here is demand and supply. The supply is in the dark line, and the demand is in the light blue or light green light. So, you can see the gap was there. And as a result, we built inventories. And the inventories reflect when you have a positive amount, as you see in the chart in the lower part of the slide, it means that you are building inventories, and this means that the market is really comfortably supplied, that we don't have what we call a tight market. In terms of oil prices, you could see that up until February, we were looking at an oil price that was at multi-year low, not only 1 or 2 years. Really, we talked about the last few years, and we started from already a much lower base than what we saw in the last few years. And if you looked at Brent forecasts for 2026, I mean, really, they were varying between mid 50s to low 60s. So that was a kind of market sentiment prevailing in oil markets. In gas markets, the picture was not that different. Here, I'm looking at the spot prices for natural gas in Europe, Asia, and the US. And you can see that, yes, we had this spike in 2022 when Russia invaded Ukraine, but then we went back immediately to, after a while, like a few months actually, not long, to relatively low levels, despite all, again, the geopolitical tensions affecting oil and gas markets and gas producers and gas consuming nations. So that was a kind of picture that we had before the current conflict. So came March this year, and then suddenly we felt that the whole Middle East ignited and is still ongoing. We had this kind of, you know what happened with the military attack, but we already started to see before the attack started with the military buildup, the American military buildup in the region, and back then was the biggest since the first Gulf War in the 90s. You could already see that prices were started to react. Yeah, we started to be concerned. But I don't think many expected this scale of war that we are seeing today. But what we have today, so we have the attacks, military attacks, but there is also what I call the verbal ping pong between Washington and Tehran. We have a strong threat from Washington. It's being countered by an even stronger threat coming from Iran. And the people in the middle, the Gulf countries in particular, they are also taking a big share of the problem between two countries that they have nothing to do with. They did not take part in this war, they did not support it, they did not initiate it, but they are definitely being dragged into this war and more on the recipient end with their infrastructure being attacked. Also, the verbal ping pong I referred to has kept the market quite nervous. And we are watching every time there is a speech or a statement coming out of Washington or there is a social media post, you can immediately see how the market reacts, as if, oil and gas prices, primarily oil prices, are reacting in real time to those statements. And today, everybody is waiting to see the deadline. I know I don't have the right timing here on my screen, it depends on where you are sitting in the world. But this morning I gave an interview and I could see on the screen in the studio of the TV station to I was talking, I could see a countdown. And just looking at that timer made me feel nervous because the problem with these deadlines, I mean, just put yourself in any situation where you are faced with a clock, a timer, and something big is going to happen at the end of that time allocated, then you become more nervous. And that's what we have today. We have more nervousness because people tend to price in the uncertainty, tend to price in the different scenarios before any outcome is clearly visible. So it's definitely not a good situation to be in, even though we don't know what the end outcome is going to be. Is it going to be a worsening of the situation, or is it going to be perhaps a deal, or is it going to be another deadline? And it is this kind of uncertainty that is causing the volatility in the market much more, I would say, than the fundamentals. And I will show you, I'll come to this point in a minute. But if you look at, so I just want to minimize, oops. Are you still seeing my screen? Okay, great. Sorry, I just need to minimize the speakers in front of me. Great. So this is the immediate reaction in the market. Prices for oil and gas, immediate jump. I'm not surprised. And I was not surprised to see that. So you can see how we went in January. Then we start seeing the military build up. And that's we saw the jump in prices, in oil prices for Brent. And the same thing with spot gas prices in Europe. The TTF prices, which are, I would say, one of the benchmarks we use, or the prices that we use to talk about the spot prices. So that was a normal reaction. No surprises here. Why not? Because you are hitting the heart of oil and gas systems, the main region in the world in terms of production and exports for both oil and gas. So any disruption, we're not talking about Iran being hit in certain targets as we saw last year, for example. We have the whole region on fire, and not only one country, but several major oil and gas producers are being affected. So to have this kind of reaction is not surprising. Worse still, you're talking about the most important maritime trade route for oil and gas. Now, it's not the only bottleneck for oil and gas trade. You do have lots of straits around the world, and you can have issues at any one of them. But there are two features that make the Strait of Hormuz pretty unique. First of all, you see the largest volume of oil and gas, LNG, going through that strait. But the second, I would say it's not just volume. So if you have a tanker that is there, it has no other choice but to go through the strait, otherwise it will be stuck there. Whereas if you go, for example, when we saw 2 years ago or 3 years ago, when the big ship got stuck in the Suez Canal, ships were able to divert the routes. Yes, they took longer routes, but they were able to have to reach their destination, albeit at a later date. The Strait of Hormuz does not have this luxury, this optionality. But the second most important thing, so that was the first thing, the volume, but the second thing is the lack of alternatives that makes anything that happens in the Strait of Hormuz, while it stays there physically, it sends ripple effects across the world when it comes to oil and gas trade. So that's really what is happening. The system is under pressure. Has it collapsed? No. And this is where I have to say that maybe I'm in the minority, that yes, I don't want to downplay the seriousness of the situation in the Middle East, but at the same time, I don't want to over dramatize it. At the moment, we are not in the worst case scenario, and maybe we won't get there. And I don't think the market is underreacting or underestimating the seriousness of the situation. And this is what I would like to spend perhaps more time sharing with you, looking at the things that should make us think, pause and think before reacting or jumping to conclusion. Again, it does not mean that we don't have maybe things further escalation. It does not mean that we're not going to see higher prices, but it means that maybe there are certain cushions in the market and structural changes that should make us more cautious when we are making quite bold and ambitious statements and forecast. First of all, as I said earlier, if you really, and here I didn't have the time to track every single statement from the White House or Tehran and to show you how prices are tracking those statements. So I just took a few days here. And when I look at something like that, when prices changing in real time with political statement, for example, first there were escalation fears, then we heard from the White House that everything is under control. Then the market said, okay, there is no risk of escalation. Then there was more warning. Then the negotiation signals. Then negotiation signals evaporated. So when I have this kind of situation, I understand it's not market fundamentals that are driving prices. It's words and not really the barrels. So this means that if there is a deal, that kind of premium, the fear, is going to dissipate. Maybe not immediately, but definitely we can see, we've already seen that. So we have not been only on an upward trajectory. There has been great sensitivity towards. And today, the prevailing sentiment, so the majority, the consensus, wherever I look in general, I hear expressions that if I was not an expert in my field, I would have definitely freaked out. So we have, for example, the IEA talking about the largest supply disruption in the history of global oil market, worse than the 1970s and 2022 gas combined shocks, whatever, and the greatest threat to global energy security in history. Wow. I mean, really, I don't know how we are keeping calm with all this. Very ambitious oil price forecast. Again, we cannot rule anything out, but I have the feeling that there is more and more expectations about prices hitting $200, and I saw some forecasts for $300 under certain scenarios. Now, these are all legitimate fears, but I can't help but noticing a repeat of what we saw in 2022 when again the IEA was talking about the biggest supply crisis in decades. Also, some established institutions talking about $200 a barrel price, $300 a barrel price, $380 a barrel price. And none of that happened. Again, it does not mean it is not going to happen today. It could. But we should also understand when we talk about largest supply disruptions, that kind of statement on its own, while it is true in absolute term, by itself is actually meaningless, with all due respect to all the institutions. Why? Simply because we are not putting it in the bigger picture, because oil markets today are much bigger than what they were in the 70s or even a few years ago. So that's why if you just take the volumes without taking consideration the size of the market, then it can be pretty misleading. The other thing, again, how we should read between the lines when we talk about closure of the Strait of Hormuz, or when President Trump sends very, very bold messages on social media talking about asking the Iranian to open the Strait of Hormuz and not repeating it verbatim. You can see that you would have the impression that there is a whole block and nothing is going across the strait. Whereas in reality, we are seeing some tankers crossing the strait. Of course, it's a fraction of what we have on a normal day before the war, for example, but it's not, there's the difference between closure and control. And definitely today, Iran has the upper hand in terms of controlling who and what can cross the Strait of Hormuz. That is a different situation that adds definitely a risk premium going forward, because if there is a deal, how much influence Iran will have over the trade and whether they will charge toll, whatever. So all these things are questions to be discussed, but they definitely do not mean complete closure. And also, when people jump to say 20% of global oil and global LNG goes through the strait, it does not mean that we lost entirely that volume. A small volume is still going through the strait, but also we saw countries like Saudi Arabia and maybe the UAE and some countries like Iraq also diverting, but primarily Saudi Arabia, some of that oil through an alternative infrastructure, for example, to the Red Sea. It does not replace all the lost volumes, but definitely it does not mean all the volumes that we used to see traded from the Strait of Hormuz evaporating or being blocked entirely. And also, I love this chart because it brings in the historical perspective, historical or hysterical. Maybe, I wouldn't rule out that we are in a historical situation today. But if you look at prices in real and nominal terms, so you take into consideration the inflation, because $1 today, as you all know, is not the same as $1 10 years ago, let alone 50 years ago or 30 years ago. And you can see that actually in blue, in the light blue line, these are the real prices. We have witnessed many episodes with much higher prices than what we are seeing today. The prices in red are the nominal prices. Yes, we are in a high level territory, but they are not unique. We have seen higher prices before and actually much higher level than what we are seeing today. And also be careful when you are comparing previous crises with today. So that's why I don't like it when people say it's the biggest crisis since the 1970s. And again, we are comparing apples with oranges. Oil markets have significantly evolved since the 70s, at least in the first oil shock. In terms of market structure is much more competitive. We have, for example, in the 70s, OPEC was the main dominant player. Today, we have a much more fragmented supply structure, and I can show you some figures on that. Even oil's importance to global energy, it used to be 50% in the 70s. Today, it's around 30. Oil intensity, the importance of oil in the global economy, how much oil we need to produce 1 unit of GDP, more than halved. And that's why you see when people talk about inflationary pressure, yes, they are there, but you need to have prices to remain sustainably high for much longer periods than just fewer spikes. And this is just an example of the structural change in oil supply leadership. And you can see how the US today is the largest producer. And not only that, shale is much more flexible. I know over and over again, over the last few years, people tend to underestimate shale production, but actually shale is very responsive to price. And here, this is a slide I took from last year where the forecast were, oh, shale production was going to peak because nobody saw prices rising so much. But again, it responds to prices, and we should not rule that out. And also taking a longer term view, you do have lots of oil around. I mean, today I was talking about Libya to somebody, but there is Venezuela, and you can see how much reserves Venezuela have in terms of production. You have lots of sanctioned oil around. So in the longer term, the situation looks much calmer than what we have today amidst the storm. And it's not just oil. Gas, as I mentioned earlier, we had this kind of spike in 2022, but prices went back to lower level. And even today, this kind of zoomed in picture I showed you earlier of high prices, they are still a fraction of what we saw in 2022. Now, of course, gas markets are very different from oil markets. Gas markets remain regional. Oil markets are global. And the two main regions for importing gas are Asia and Europe. So that's where usually we look at the competition between those two regions. And not only that, it is a regional market, but it has been changing a lot, especially through globalization. And globalization, not in terms of like the globalization in economics term, but in terms of gas trade. Something, again, people underestimate that very important structural change. In 2021, roughly around that time, LNG trade overtook pipeline gas trade. Now, why this is important? Because LNG is a completely different animal from pipeline trade. It brings with it lots of flexibility in terms of contract structure, pricing mechanism. But also we have seen, for example, look at 2002 LNG exporters. Very few countries, and Indonesia was the highest with 30 billion cubic meters per year in terms of exports. But looked at in 2024, which is still valid today, you can see how it has become more colorful picture, more and more exporters. So it's definitely a much more competitive market structure. And it is the US that is the largest exporter of LNG, and then Qatar and Australia. I don't want to underestimate the problem that has happened in Ras Laffan, but yes, it definitely brings volatility, but it's part of the transformation, this volatility in gas market. So when we talk about spot pricing for gas with LNG, we have to accept that with that kind of pricing, we should expect volatility. But volatility is not necessarily bad in well-functioning markets. It means that if we have spikes and crises, it's a question of time, and rather quicker time than, let's say, if you did not have this kind of flexibility, that prices readjust as we saw in 2022. So this is really the reality check, and I know I went quickly through all that, but I would like to leave plenty of time for discussion and comments. But let's try to gaze through our crystal ball here, which is pretty foggy and cloudy. First of all, I know that it's a major disruption, but I don't believe all of it is going to be permanent. And remember, largest disruption does not necessarily mean largest crisis. And so far, we know that a large share of the shock reflects logistical constraints and not necessarily structural damages that will take ages to be reinstated. And that's why I say that all markets, yes, they are functioning under strain, but I don't see a breaking point yet. We are not there yet. And remember that prices are also reacting to uncertainty and signal, and not just physical shortages. But whatever happens this evening and whatever happens in the coming weeks, whether we are talking about conflict or calm, I don't believe that oil markets will be the same again. So it's not just, oh yeah, it's one crisis, we turn the page and then we go back to the good old days. I think that often what we see, and when you study history of the oil and gas industry from the 1800s, you can easily see that when you have disruptions at this scale, it's very unlikely that the markets just go back to what they used to be before that crisis. We know that these kind of disruptions rarely pass, and actually they tend to accelerate the structural shifts. In the 70s, after the first oil shock, we saw a lot of demand destruction. We saw gas becoming more popular in power generation. We saw efficiency gains. We saw different kind of cars being manufactured, etc., etc. And today, even though we had deceleration in the energy transition, with people perhaps turning away from certain investment, we might see a readjustment in that. But above all, I would say don't underestimate the potential of demand destruction, nor the ability of markets to adjust to the current crisis and the current price signals that we are seeing. And with that, I thank you very much for listening. And now I'm ready to take all your comments, criticism, and questions. William, back to you.
Thank you so much, Dr. Carole. Really, really great presentation, because it answered some really good questions I already received. One of them is related to what you mentioned at last, demand destruction. So if countries now move to more alternative sources of energy, so solar, wind, nuclear, etc., which countries do you see benefiting the most from that transition?
Well, it's easier said than done, first of all, because I mean, nuclear, you have to understand that's not going to be ramped up very quickly. I know that there are people saying we should move back more into nuclear and things can change. But again, we can see that maybe happening in a matter of years and not in a matter of months. But definitely there are countries and regions better placed than perhaps before and then others. If you compare, for example, the reaction to the crisis in Europe today versus the Ukraine war in 2022, I mean, the Ukraine war is still ongoing, but when Russia invaded Ukraine, you can see that we're not getting the same sense of panic. Yeah, back then
Hmm.
it was panic everywhere, demand management policies announced everywhere, government interfering to support consumers and industries across Europe. We have not seen this perhaps yet in Europe. And this gives me an indication that maybe, for example, a country like Europe, with all the policies that they enacted, are providing a better shield to handle this kind of crisis as, for example, only a few years ago. Asia, I don't like to generalize about Asia because it's a very, very diverse picture, and the reaction and the preparedness of some countries is also are also very different. But I would say when I look at China, for example, China not only in terms of investing in building the huge capacity for green energy, including nuclear, but also solar and wind and hydropower, you name it, it is well placed. But more importantly, China, last year or the year before, the last 2 years, we were wondering, for example, when people said, okay, where is demand growth is coming from? And all eyes would turn to China, but not because China was really booming economically. They still have structural problems, but China was building a lot of storage. They were taking advantage of cheap oil, especially sanctioned oil from Venezuela, from Iran, from Russia, and they were building strategic and commercial storage and inventories. So that could give them a better protection from, let's say, other countries who don't have this kind of luxury in terms of storage. Other countries, the poor countries in Asia, I'm thinking about Vietnam and Philippines, they are already struggling. But is it because they did not invest in renewable energy? Not really. This is unfortunately reality of not having the economic strength to weather through the storm or to sail through the storm without imposing some or taking some hard measures to shield the poorest in the country. That said, I need to highlight just one aspect, William, and I know you may sympathize with me because we're both economists. I hope people have learned from the crisis in 2022 when it comes to policies, because we know so far that the most powerful signal that creates behavioral change is the price signal. And often simply blanket policies from governments without being targeted, without addressing the needs of those who are most vulnerable, they may provide a temporary shield, but they tend to backfire in the longer term. And that's the unfortunate reality that many governments have not learned the lessons, and that's why we don't see better outcome when this kind of crisis hit. And there is no guarantee that even if the crisis is over today, that we will not face other crises, similar crises in the future. We are living in a mad world. That's the unfortunate reality.
Thank you so much. Just to let you know, we have a lot of questions and less time. So if I give you a quick one now, it says, how long will it take for the oil prices to normalize if we stop the war today?
Well, I don't like to talk about oil prices because really nobody can predict the oil prices. But I can tell you one thing, that first of all, it depends on if the war ends today, then so what? Does that mean that the risk premium is going to evaporate? I don't think so. On what terms will the war end? What about the Gulf countries who have been sitting there being exposed to the war and they have been under constant attack from the Iranians? What about, the trust in those countries? What about the trust in their neighbor? So I think that even if the market fundamentals are corrected, so we don't have supply shortages, physical supply shortages, and again, it depends on what terms we're going to see the war ending. I doubt the risk premium is going to dissipate anytime soon, but I also don't believe it will stay in a high oil price territory for too long. And again, whether you're talking about days or weeks or months, I prefer not to be that precise.
Lots of questions around inflation for sure, but one related to currency. So we know that oil is priced in US dollars. What about now Iran wanting to sell it in yuan and other currencies or maybe cryptocurrencies? Do you see this becoming a trend or just like a one-off event?
No, no, this is not the first time that's being mentioned. Actually, it has been mentioned over and over again. And yes, there is of course some oil being traded under non-oil denominated currency. I mean, think about Russia, for example, selling its oil to other nations, sanctioned oil. So it is there, but really it's just a tiny proportion, very, very tiny of the globally traded market. And therefore, you may get away with selling few barrels here, millions here and there, but not enough to create a structural change. It's already happening. And China, for a while, has been pushing for it, but they have not reached a point where they could spread it beyond a certain proportion. So it will continue to be for the foreseeable future denominated by the US currency, US dollar.
We have another question related to who are the winners of this conflict, if you look from a macro point of view.
Look, in every conflict, whether we like it or not, there are winners and there are losers. And we may not see all the winners, but actually, anyone who is selling their oil in global markets must be making a good fortune. That's what we call the windfall. So, what we have in the oil and gas industry, especially in oil, the economic rent that often are the result of a situation such as this. So, if I were to give a very, very simple answer, I would say anyone who is selling oil and producing the oil and selling it, they are making a lot of money. Traders, some traders, and volatility. And the whole thing, the whole list goes on and on. But the key point for me is not who is winning, because definitely lots of people winning. And you saw, for example, I think was it 2 weeks ago, when just before President Trump announced that there could be some negotiations with Iran, we saw how there was big trading operation and huge investment made, and I don't know, lots of money made as well, and that has drawn some kind of curiosity, to say the least, and maybe it's still being investigated. So there's always be somewhere there winning. I mean, think about the defense industry, for example. Oh my goodness, this is really big time for them. But let me just highlight one important point, because that is relevant, especially if we have people joining from resource-rich countries in Africa. you know, Generating the revenue is one thing, but investing them wisely in the country is another. So you may have winners, let's say, again, at the top level, but then that does not mean that the country is going to be super wealthy. If anything, usually, unfortunately, the windfalls on a government level do not. I do not get invested wisely just to keep it at that level.
Great. In this stagflationary scenario we are in, lots of people anticipate this, lots of macroeconomists anticipate it. What do you see central banks doing in that scenario?
It all depends, and I have the feeling that many are still in a wait and see mode. So even when we talk about inflationary pressure, yes, you will see it. You are already feeling it. I had somebody cleaning my house yesterday, and they came and asked for a rise because they said it's costing them more to fill the car. My brother-in-law came to visit us a few days ago in his electric car and not his diesel-based van. So you do sense the inflationary pressure everywhere. But again, there's a difference between temporary or something that's going to be with us more permanent. And I don't think anybody will jump into action or take drastic action if before we are convinced that these inflationary pressure are not just temporary, but they're going to stay with us for a while. But that said, if you look, for example, at the IMF published a study recently. They said really for inflation to be more established and all the other macroeconomic problems to become more notable, we need to see prices to remain at current level or even higher for not for just a few months, for at least the end of this year. So this is a kind of duration we need to look at to really talk about problems of inflation or stagflation or what central banks are going to do. But so far, I think everybody is watching with great caution what is happening in the Middle East, but we are all sailing through the fog. But I doubt anyone will jump into taking this important policy decision, unless they are more convinced that this is something that will stay with us until at least the end of the year.
Plenty of questions around the future market and the spot market. So how do the future market react, or how do you see it reacting going forward with this crisis?
And it's difficult to say, William, but because we are living with great level of uncertainty, right? When you have this kind of uncertainty, I would be very careful in terms of interpreting whatever prices I'm seeing in the physical and the future market. But I'd like to take the opportunity here to clarify something I saw people discussing on social media platforms because they looked at the delivery price of one kind of crude, I think it was in the North Sea, and they said, wow, it was $140 a barrel, and these prices we did not see recently. We only saw, for example, in 2008 or 2022. But this is like comparing apples with oranges because we're not talking, we are comparing, for example, a delivery price with a market price for a certain month or year, a few years ago. So it's creating a lot of confusion and uncertainty. And in the middle of uncertainty and volatility, I don't think the future market can tell us with great certainty where things are heading. So I would look at all these figures with a big pinch of salt, bearing in mind the kind of uncertainty we have at the moment.
Great. Lots of questions around fertilizers. Apparently, 20 to 30% of fertilizers navigate through the Strait of Hormuz. Is it worrying you regarding future prices of food that we put on the table?
Well, William, look, I mean, if I were to speak as a human being, I would say any increase in price that affects, especially our basic needs, and here we're not talking about luxury like traveling or going on holidays, then I get worried because I'm thinking about the poor countries exposed to all these high prices for food. So that's definitely going to worsen poverty around the world and economic performance in certain countries which rely on imports of agricultural products. But if I were to put my economist hat on, I become less worried because not that it is not going to get worse, but I say it's too early to tell. So yes, we have a temporary crisis, but it all depends. So any questions you're going to ask me about fertilizers, about diesels, about jet fuels, about oil, about gas, we all come up with the same answer. It depends on how much longer the conflict is going to continue and the disruptions are going to continue, but this is part of the answer. And the second part would be, and how fast are alternatives going to be made available? So it's not just a question of duration of the conflict, because we should not look at the market as a static image. So that's when people talk about 1 million here, 2 million barrels there. They are useful stress tests to see different scenarios, but we forget that the market is dynamic and there are different parts moving at the same time. And I would say the two conditions for me that would make me more worried is a longer conflict duration, a more widespread conflict. So it's not just the duration between US, Iran, Israel, but really dragging other countries further into the war, more damage to trade infrastructure. And then at the same time, no alternatives are being made and no efficiency gains achieved, for example. So then I would definitely become even more worried.
Great. Some questions around the price volatility of oil. And should we, I mean, if this conflict is hopefully peacefully resolved, do we expect less volatility, or the markets will still need some time to settle? Because there, there, I mean, some infrastructure has been destroyed, right? Whether we like it or not, it happened, and now we need to deal with fixing those um, factories and facilities, and then to go back to normality. So, where does volatility take us?
Look, as long as there is no clear settlement of the situation where you know that not everyone, every day somebody changes they have a new idea or their mood changes and they are going to start attacking their neighbors. So even if you have, let's say, and I said earlier, if the war ends today, I think we will continue to see a risk premium ongoing. Now, the risk premium, you tend to see more volatility usually because depends on market sentiment, what you believe in, what you don't believe in. But usually, the longer we go further in time away from the actual war date, the more the situation normalizes. So I would say we're going to see, if the war ends today, we will see volatility, and then it dissipates, not dissipates entirely because it's a global market. You should always expect a volatility. It would be, for me, abnormal if the market, such as oil markets, global oil markets, did not have volatility. The big question is not whether we have volatility or not, but how quickly can the system adjust? And I know, William, you said the infrastructure. I agree. There has been destruction in terms of infrastructure. But the problem that we have today is more of a logistical problem, like the Strait of Hormuz. And I'll give you an example. I bet you that if there is a deal in terms of allowing the full trade of oil and gas through the Strait of Hormuz, you are going to see a notable reduction in prices, assuming that the market believes that any kind of deal is going to be more lasting than a day or two. If it was more structural damages, like to energy infrastructure, which cannot be repaired within a few months, or which are going to require the shutdown of oil and gas production facilities entirely, then it's a different story. Then you would see a more lasting impact, and perhaps the system struggles to adjust quickly. But again, I struggle to see how that becomes like a static image, because I'm thinking about production elsewhere. US oil production, there is always potential there on the upside. What could happen elsewhere in Venezuela and Libya? Yeah, these countries where there is some potential, and maybe again with some boost in investment and support and government policy that could also contribute. Maybe if there is a deal with Russia, and the Ukrainians, for example, stop attacking some Russian ports and trade facility, that would also take away some of the risk in the market. So there are lots of ifs and maybes, but at the moment, I don't see the structural problem overtaking the logistical problems. I think we are still in a place where the logistical constraints is still having its biggest impact on prices, and you deal with that, you might appease the nerves a bit in the market. And then we can assess properly the damage to infrastructure and how long and how much will be lost and how much will come back to the market and by when.
Great. Lots of compliments, by the way, on your presentation. And one question to follow up on this is part of the reaction you have helpfully captured heightened because this is one aspect of a larger system change in geoeconomics?
Say it again, William. I'm not sure I
So
got the question
is
correctly.
part of the reaction you have helpfully captured heightened because this is one aspect of a larger system change in geoeconomics? Do you see a change in
Absolutely.
geoeconomics?
Absolutely. And that's why I started the first part of my presentation was to put what is happening today in the bigger context. That there have been some structural changes, some forces in action over the last few years, even over the last decade, that have been, supporting each other. I would call it like a souffle. And this is, and what we are seeing today may be part of that kind of trend. But I want to go a bit before the last maybe 10 years. And I'm going to say something that may be seen as controversial by some of you. Actually, I wouldn't rule out entirely that if we did not have the share revolution in the US, we would have had the same scenario today. I think the share revolution was a pretty disruptive trend in oil markets and gas markets, but also in global geopolitics, especially in the relationship between the US and the Middle East. And it would be completely simplistic and naive to believe that the share revolution, which allowed the US to overtake Saudi Arabia and to overtake Qatar for oil and gas productions, oil and LNG production, I find it extremely naive to believe that this has not played any role in shaping the US attitude towards the Middle East. We have seen a more detached US, and we also have seen a more aggressive US when it comes to the Middle East. So, definitely, to answer that question, if I got it right, what is happening in the Middle East today has to be placed into a much bigger context, related to oil and gas and also beyond, like these global trends of fragmentation, deglobalization, blah, 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 as well as the kind of flexibility and freedom and power. I mean, President Trump was not joking. He's talking about energy dominance. You cannot have this kind of energy dominance without allowing it to influence your foreign policy. So it's maybe a much bigger question what we are discussing today, but it's definitely something that I think about, and I think it has definitely played a role.
Just a quick comment. It's interesting on the slide that you showed earlier where there's a conflict, there's oil and gas. So it was mind-blowing. Does the war tarnish the reputation of the US nowadays? Because somebody asked the question and you just mentioned it. How do you see the image of the US now globally after this conflict?
I mean, definitely for many people, they see the US as being pretty aggressive, but not aggressive like necessarily in a bad way, but definitely more in your face, more confrontational today than perhaps it was not long ago. So that is perhaps more visible. You can see it in the White House and the statements that are coming from Washington. But William, it's not really the US reputation in terms of how its attitude and its image. It's also how other countries are seeing the US, even its closest allies. We saw how NATO refused to be involved in this war. But that has gone, even the closest allies, let's say to the US, in the UK, in Europe, they did not want to take part because don't forget, last year they were punished by huge tariff rates. So that again, and, lots of threats, lots of things. But I'm also thinking, again, this is my personal perspective based on discussions I have had with relatives and friends who have nothing to do with politics, have nothing to do with economics or oil and gas markets. But you have to really recognize that if you were sitting in the GCC and you have relied for years on kind of your ally, your partner, that is the American power, for some kind of protection, what happened to that protection today? What does that mean going forward? So it's not about reputation or image, but it's definitely, and that's why I said a crisis like this is not just going to pass. It's going to raise many questions. Maybe we're going to see new kind of collaborations, new kind of cooperation, new kind of alliances, because this crisis is going to force many people to stop and pause about their existing relationship with their neighbors, but also with global powers. So it's not just about the US and how they are and whether President Trump sent a naughty tweet. It's much deeper than that. It's about the trends going forward for many years to come, and they are being rewritten.
Thank you. We had a few questions around the Strait of Hormuz and how do you see this after, let's say, if you stop the war tonight, how do you see the strait operating and the extra costs to the price of oil because of that strait new management, I would say?
I think that's a $1 million question because it depends on how this war is going to end. I mean, if the war has shown something, is that Iran can clearly control the Strait of Hormuz. So as long as that control is going to be there, we have to try to work out scenarios in terms of what does that mean in a peaceful environment. Does that mean that now Iran, whose economy is really in very bad situation, it was already before the war. Now with all the damage that has happened, it's even getting worse with all the unrest that we saw before the war domestically, with people protesting out of frustration, not with the regime necessarily itself, but of course the regime played a role, but also because of all the dire economic conditions they have been living under. So I wouldn't rule out that Iran may want to make some bucks out of its control, translate its control into some lucrative business. From the Strait of Hormuz. And yes, if that happens, and again, we're all speculating here, right? Because I mean, we shouldn't rule out any kind of scenario on the political front as well. But let's say under that scenario, that yes might add some premium to prices. But again, it's a question of duration, for how long and for when. That depends also, and also what happens with sanctions on Iran or any potential deal, that does it mean that there will be some alleviation of the sanctions in return of a safe passage and no tolls being charged on any tankers passing through the Strait? So lots of questions. We have to dig deeper into understanding what can happen next with the Strait of Hormuz. But unfortunately, that's one consequence of the war, is that it showed who has really the upper hand in the passage through that choke point.
Thank you so much. There's another question. Let's hope it's not the case, but in case this goes on and on for another couple of months, with the consequences that you can imagine, higher oil price, higher gas price, inflation, etc., what would be an adequate risk premium should we give it to a security related in the region? So we're talking about the GCC region, and definitely the question is from a portfolio manager or an analyst asking, what would be the consequences on a risk premium? Because now we need to integrate and factor this risk premium that we didn't have before.
Yes, but you will adjust to it over time, right? So you will have a risk premium in the short term, whatever short term means to different people. But I'm thinking about it not just in terms of risk premium, but in terms of rewards. So maybe even though there is a higher risk perception, let me narrow this question more into the region and the investment climate in the region. Yes, maybe there is now at the moment a very high risk premium that's going to stay with us for a while, but that could be, again, it depends on the kind of investment portfolio you're building or what kind of investor you are. But it does not mean that's going to stay there forever. I have not seen a high risk premium attached to one area or one region or one country lasting forever, right? It tends to dissipate, and there will be other factors that can more than compensate, for example, for that risk premium. So there's nothing cast in stone, and I wouldn't rule out some initiatives taken by the countries in the region, by the GCC, who care so much about their reputation, the kind of image they would like to convey to the rest of the world. And yes, that image may have been bruised with the ongoing conflict that they had nothing to do with, but I'm pretty sure that they are putting the kind of infrastructure in place, policy infrastructure measures to kind of compensate for that kind of uh, uh, crisis. I don't want to use this word crisis, but conflict that we are facing today. But it's very difficult to see how a risk premium can be embedded for a very long time in a highly fluid situation. You know, in all this dark situation we are discussing, we are not talking about what could happen in the longer term as a better scenario for the countries in the region. I mean, one outcome that should not be ruled out entirely, if there are some structural changes, and I don't want to go into politics, but that can really result in a lasting peace, and not a situation where everyone, you know, one day they have a few missiles here and there, they start attacking some facilities and cause disruptions. Also, that should not be ruled out, because maybe we have to go through the worst to get into a better situation. I don't know. I'm not saying that could happen. I'm not saying that I support that scenario, but I wouldn't rule it out either. And that could be a good outcome, actually, particularly for the GCC.
Great. We're almost running out of time. I want to end with an open-ended question, and I'm going to read it literally. Does the current, sorry, I lost it just a second. Okay. Okay. Does the current war pose, yes, does the
Make it
current war,
easy. Make it, pick the last one, be as easy one.
no, I'm going to make it like a PhD request. Does the current war pose risks in resetting global norms in terms of sovereignty, in terms of nations' right to determine their own domain and future? And what does this new world mean in terms of the protocol that historically been set by the WTO to manage the spaghetti bowl of global trade agreement?
We run out of time, William.
Saved by the
But look,
bell.
I mean, look, it's a very philosophical big question, and it deserves all the time, because yes, whoever asked that question is absolutely right to raise it, because I mean, what's happening today makes everyone think. But are we going to see a change to sovereignty, on sovereignty and rights of people in their own country? I don't think so. I mean, if it was going to be the case, we would have seen everybody jumping into this war and joining the US and Israel into this war. And we can see how everybody is still waiting, because they know that there is it's one thing to achieve political goals, another thing to respect international legislation and rules of law. So no, I wouldn't say it's going to be a change in sovereignty, but definitely in terms of global trade, relationships, etc., that it is changing. It's not that it will change, it is already changing. So we may see an acceleration of the trend, or maybe we might see a reversal of the previous trends, and maybe countries who felt isolated before feel more integrated today. Let's wait and see.
Do you allow me two fast last ones? On one of your slides, you showed that Saudi Arabia is able now to export some oil through the pipeline to the Red Sea. You've showed also that Abu Dhabi could also send oil through a pipeline to Fujairah. I mean, Saudi, I'm sure it's working. Is Fujairah already working? And these solutions, when do they help the region to bypass Hormuz, if possible at all?
William, for the figures, for the numbers, again, I have seen different figures. So, for example, Saudi Arabia, I saw as little as 3.5 million barrels a day to 5 million barrels a day. And some people talk about increasing it to 6 million barrels a day. You know, we don't want to go into the details of the numbers or whether Iraq is sending other more oil to the Mediterranean through the pipeline that goes to Turkey, or maybe if the UAE is diverting any of its oil. But the simple fact that you are showing that, oh, hold on a minute, there is some alternative to the Strait of Hormuz that by itself can take away some of the heat that we are seeing today in the market. And that is important to understand. That said, none of these facilities are risk-free because there is no guarantee that missiles are not going to be targeting that pipeline in Saudi Arabia, for example, right? But at the moment, the mere fact that we do have some alternatives
Yeah.
is also taking away some of the pressure that we are seeing in markets. And the more people who hear that there are some tankers sailing through the Strait of Hormuz, the less anxious they become in terms of the gravity of the situation.
Last question.
You said last question. It's okay. No, no, please go ahead.
No, this one is just for your crystal ball to be helpful in this Q&A. If you look at your crystal ball and I asked you tonight to give probability of a deal or no deal before midnight tonight, what do you think?
Honestly, I'm 50-50. For the first time, perhaps in my life, when it comes to scenarios, I'm struggling to place a probability on those scenarios. And if I may end this conversation on a very controversial note that I know it will not make me terribly popular, then I tell you why I have this 50-50. Of course, I'd like the conflict to end ASAP. I don't like wars. I don't like killing. I don't like disruptions to infrastructure. I don't like innocent people being dragged into a conflict that they had nothing to do in. But at the same time, I am concerned about what kind of deal we can have. Is it going to empower some players that have for years caused disruptions? If that is a kind of deal, then I'm not quite sure. I hesitate. But again, definitely, if I were to choose between war and peace, I will always choose war. But if you are peace, not war, so excuse me, you have to. I'm Lebanese, that's why it always the word war comes to my mind. But definitely, I would choose peace. But you asked me to allocate probability about deal or no deal. I'm not quite sure I'm allocating the 50-50 objectively, but it's definitely reflecting my kind of concern whether we have a deal or no deal. It all depends on the terms of the deal, right? Not every deal is a good deal at the end.
Thank you so much. It's been so long that at the end I mean, really exhausted your powers. Thank you so much. It's been so helpful. I can't tell you how many people are sending claps and hearts and
Thank
thankful
you.
messages. And really, everyone, I hope that everyone liked the presentation. I really loved it. And I hope tonight, all of us at midnight, we will find a deal that's hopefully a peace, a long-term peace that will help us all to go back to our normal activities. I want to thank all the CFA societies around the world that participated in this great webinar. Please stay safe and fingers crossed for a peaceful resolution of all the wars around the world. We didn't have time to speak about Ukraine and Russia and others. Really fingers crossed for a peaceful world where we worry more about AI and other stuff. Thank you so much.
Thank you very much.